Imagine waking up one morning to see the financial headlines screaming in red. Markets in freefall. Worst crash since 2008. Billion-dollar funds panicking. Retail investors frozen. Social media flooded with fear. Economic analysts on news networks explaining how nobody saw this coming again. But what if, as millions panic and scramble to sell, there are just a small handful of people watching this video right now, who won't be among the helpless? Instead, they'll be quietly positioning themselves not just to survive the crash, but to rise from it stronger and potentially wealthier than ever before. Because what you're about to learn in the next 10 minutes is something almost no one will ever tell you. Market crashes don't just destroy wealth, they transfer it. And history has shown that the greatest fortunes in the world often emerged at moments when the rest of civilization was staring into economic darkness. This is a deep dive into what nobody explains, how crashes actually generate wealth, why most people miss out, and how a select few learn to think like architects of opportunity rather than victims of catastrophe. Today we take you inside the patterns of collapse, from the roaring 1920s to the brutal crash of 1929 that minted millionaires in the ashes, from the dot-com bubble burst where the tech giants of today were born, to the chaos of 2008 when those who understood liquidity margin strategies and distressed asset cycles multiplied their net worth. You are about to see how the next possible crash, forecast by several macroeconomic analysts to hit around 2026, may not be a disaster, but a once-in-a-decade window for intelligent, educated financial positioning. Before we move forward, I want you to understand something powerful. This video isn't about predicting doom. It's about exploring possibility. It's about learning to think differently from the crowd. Ask yourself, when fear hits the market, will you be part of the panic, or will you be one of the few who profits from it? Because history shows us that when markets crash, fear is at its highest, but valuation discounts are at their deepest. Assets are sold not based on worth, but on desperation. Weak hands exit. Strong hands accumulate. Wealth doesn't disappear, it changes owners. If that line alone just shifted your perspective, let me know in the comments right now. I choose to be ready. And if you're serious about transforming your financial mindset and staying ahead of economic moves before they hit mainstream headlines, make sure you subscribe and turn on notifications, because the next few videos will build on this exact blueprint. Every second of what you're about to hear matters, so stay with me until the end. So what's brewing? What could set 2026 apart? Analysts studying debt cycles, credit tightening, and liquidity rotations have pointed toward what they call a pressure event, a moment when interest rate policies, geopolitical disruptions, and the artificial liquidity pumped into markets since 2020 collide with slowing growth and consumer weakness. Similar patterns emerged before 2000, 2008, and even 1929. But here's what almost nobody talks about. While fear destroys, liquidity creates. Those who understand how to be liquid at the right time, those who can identify which sectors will bounce first, and those prepared to buy when the world is selling. These are the ones who use market crashes to accelerate their financial position 5 to 10 years ahead. The average investor plays defense when they should be preparing for offense. And the difference between those two decisions? It's not timing. It's not luck. It's education, which is exactly what this episode provides. As we move into the next part, I will walk you through, step by step, the 3 mechanics behind how wealth is made during downturns, how to identify the psychological coding that pushes markets beyond rationality during crises, how to recognize undervaluation before recovery signals appear, and finally, how to position without gambling, using strategies historically deployed by institutions, hedge funds, and financial elites during collapses. Because crashes are not about chaos, they're about transitions. And transitions are when power shifts. Stay with me. This is where the paradigm truly breaks. Now, let's go deeper into the core mechanics of how the 2026 crash could potentially make you rich if understood correctly. Let's break down the first mechanic, understanding the psychology of fear. When a crash hits, it's not just numbers on a screen falling. It's an emotional contagion. The media amplifies the panic. Retail investors see their life savings shrink, and a primal fight-or-flight instinct kicks in. The rational brain shuts down, and the emotional brain takes over. People sell not because the fundamental value of a company has vanished overnight, but because they are terrified of losing everything. They sell into the downward spiral, pushing prices even lower, far below their intrinsic worth. This is what we call irrational pessimism. This is the moment when a solid, profitable company can be trading for a fraction of its true value simply because it's caught in the market-wide sell-off. The key is to detach your emotions from the market's emotions. While everyone else is reacting to the noise, you need to be listening for the signal. The signal is the disconnect between price and value. How do you do that? You prepare now. You have a watch list of fundamentally strong companies you'd love to own at a discount. You set your price targets in advance when you're calm and rational. So when the crash happens, you aren't making a decision in the heat of the moment. You're executing a plan you already made. Now for the second mechanic, recognizing deep undervaluation. This goes beyond just by the dip. Anyone can do that. True wealth is built by identifying what's being unfairly punished. During a crash, the market doesn't discriminate. It sells off everything, the good, the bad, and the ugly. Your job is to sift through the wreckage and find the diamonds. Look for companies with strong balance sheets, low debt, and a durable competitive advantage, what Warren Buffett calls a moat. These are the businesses that will survive the economic winter and thrive in the recovery. Think about sectors that are essential. People will still need healthcare, consumer staples, and energy, regardless of the economy. Also, look at the technology that is becoming mission-critical for businesses. While some speculative tech stocks might get wiped out, the companies providing essential software, cloud infrastructure, or cybersecurity will likely recover much faster. The goal isn't to catch the exact bottom. That's a fool's errand. The goal is to buy excellent assets when they are on sale. You don't need to be a genius to see when a blue-chip stock is 50% off. You just need the courage and the capital to act when others are paralyzed by fear. And that brings us to the most crucial mechanic of all. The third mechanic, strategic positioning. This is where the amateurs are separated from the pros. It's not about going all in on one bet. It's about a disciplined, phased approach. The first rule is liquidity. Cash is not just trash sitting on the sidelines. During a crash, cash is king. It's your power. It's your ticket to buying assets at a generational discount. Start building a cash position now, not by selling everything, but by systematically setting aside funds for this exact opportunity. Second, don't try to time the bottom. Instead, use a strategy called dollar cost averaging, but on steroids. Instead of buying a fixed amount every month, you deploy capital in tranches as the market falls. For example, you might invest 20% of your available cash after a 20% market drop, another 30% after a 30% drop, and save the rest for when there's extreme fear, what many call the point of maximum pessimism. This way, you're buying more shares as prices get cheaper, lowering your average cost. Third, think long-term. The wealth from a crash isn't made in a day or a week. It's realized over the next 3, 5, or 10 years as the market recovers and eventually reaches new highs, which, historically, it always has. You are not a trader trying to flip stocks. You are an investor buying a piece of the future at yesterday's prices. The patience to hold through the recovery is just as important as the courage to buy during the crash. So let's recap. The 2026 crash, or any crash for that matter, is a massive transfer of wealth disguised as a catastrophe. To be on the right side of that transfer, you need to master 3 things. 1. Master your own psychology by preparing a plan now, so you can be rational when everyone else is emotional. 2. Learn to identify high-quality assets that have been unfairly beaten down, separating the signal from the noise. And 3. Position yourself strategically with cash and a phased buying plan, focusing on the long-term recovery, not short-term timing. This isn't about being a pessimist. It's about being an opportunist. It's about understanding the cycles of history and having the foresight to prepare. The financial storm will come. The question is, will you be building a flimsy shelter, or will you be building an ark? If you found this breakdown valuable and you're committed to changing your financial future, do me a favor and hit that like button. Make sure you subscribe and turn on notifications because our next video will dive deep into specific sectors that historically perform best after a market crash. You don't want to miss that. Leave a comment below and let me know which of these 3 mechanics resonated with you the most. Thank you for watching. I'm here to help you get ready.